Yeah, we will look into another main heading today, that is payment system. Okay, right, we'll start. And there are few topics that we can discuss. I'll first take primary dealers. Now, who are primary dealers? Yeah. Now, when I show this one, can you see the slides? Primary dealer. Say yes or no, then we will continue. Primary dealer. Can you see the slides when I show them?
Yes, sir.
Right, thank you. Okay, a primary dealer means a firm that buys government securities directly from the government and sell it to the general public. Means what? The government issue treasury bonds when they need money. But general public cannot directly buy these government securities from the government. So what happened? You have to buy it through an agent. That agent is known as primary dealer. So a primary dealer is a firm that buys government securities directly from government. The intention is to resell the securities to others. Okay. So sometimes back you have heard perpetual capital, the treasury bond scam, so many other things. Right. So primary dealer is buying from government in order to sell to the general public. Therefore, primary dealer act as a market maker for government securities. In simple, who is a primary dealer? Primary dealer is the market maker of government securities. The government may regulate the behavior and number of its primary dealers and impose conditions to entry. So not everyone can get into primary dealer business. Through primary dealers, government issue their securities to the general public. Okay. So for exam purpose, if you asked who is a primary dealer, market maker for government securities. So primary dealer is the market maker for government securities. Some governments sell their securities only to primary dealers. So most of the countries, government sell their securities only to primary dealers. Government that use primary dealers include Canada, France, okay, these are the countries. Right. Governments, when they need money, they issue treasury bills, treasury bonds. And the objective of this primary dealer system, now what is the system? Government is not directly selling their securities to the general public. It happens through a dealer, the first dealer. So the term is primary dealer. The objective of having this system to strengthen the infrastructure in government securities market in order to make it vibrant, liquid, and broad-based. So you have to remember, if government is trying to sell their treasury bills to everyone, it may be difficult. Therefore, through few dealers, you can easily sell them. So the first objective is to strengthen the infrastructure in the government securities market. So the second one, to ensure development of underwriting and market making capabilities of government securities outside this one RBI, Reserve Bank of India. Means what? Outside the central bank, so that the latter will gradually shed these functions. Right. So the purpose is central bank is not directly selling, or in America you call it Federal Reserve is not directly selling. In China, you may call it People's Bank. In Norway, Norges Bank. In India, Reserve Bank of India. In Sri Lanka, we call it CBSF, the regulator. They are not directly selling. So, to ensure the development of underwriting and the market making capabilities of government securities outside the central bank, that is the purpose of having primary dealer. Number three, to improve secondary market trading system, which would contribute to price discovery, enhance liquidity, and turnover and encourage voluntary holding of government securities among a wider investor base. There must be secondary market. Means what? Government is issuing, the primary dealer is buying and selling into secondary market. That process is strengthened by having a dealer. To make primary dealers an effective conduit for conducting open market operations. Okay. So when government want to, right, let's look into like this open market operation. Okay. Open market operation mean when government sees there is inflation, government intervene by adjusting interest rate. Okay, let's make it very simple. Assuming there is a country, this country can manufacture only one pen, and the country has only one gold coin. Okay, means what? Money supply and the production. That's what I'm saying. So money supply here represented by one gold coin, and the manufacturing, the total output of the country. I here take the example one pen. Okay, tell me the price of a pen. The whole country has one gold coin, and the whole country has one pen. What is the price of a pen? Yeah, your money supply equals your output. What is the price of a pen? All what you can offer is one gold coin. All what you can buy is one pen. Now, what is the price of a pen? Yeah, one. Can someone tell me the answer? All what you can buy is one pen. All what you have is one gold coin. So what you will, if you want to buy, you will offer what you have. So the price of a pen is one gold coin.
Gold coin.
Right. Correct. Now assume the country somehow found another gold mine, and now they have two gold coins. But the manufacturing has not improved. The country could not improve the manufacturing facility. So the country has one pen. Now what is the price of a pen? You have two gold coins. The country have somehow found more gold. Means what? Money supply has gone up. They have printed more money. So you have two gold coins. But still you are manufacturing one pen. What is the price of a pen? Two gold coins. Two gold coins. What has happened? Price of a pen has gone up. What do you call it? You know the nice term. The economists say it often. What is that? Price has gone up. Inflation.
Inflation.
Inflation. Very good. Now just think my example. Now we have two gold coins and one pen. Okay. Price has gone up. Why price has gone up? Because the money supply has gone up. Okay. Tell me two methods where you can go back to your old ideal situation. The old ideal situation is one pen is one gold coin. Tell me, how can you go back to your ideal situation? Current situation is price of a pen is two gold coins. Tell me mathematically two methods where you can make price equal to old one to one gold coin equals one pen. Tell me, how can I match that now? There are two methods. Reduce the supply of money. Very good. Very good. Reduce the supply of money. That is, I have to remove one gold coin from the money supply. Then money supply is 1, production is 1, 1 is to 1. Okay, what is the other one? Reduce the supply, correct. That is, reduce the supply of money. What is the other one? If I have to remove one gold coin, now the price is 1. Tell me another method. Tell me another method. There's another method. What is that? One is reducing the gold coins. You have to make it somehow 1. Then it's 1 to 1. Price of one gold coin, price of 1 pen is 1 gold coin. What is the other side? There's another side. What is that? Reduce money supply. Yes, you can go back to your earlier ideal one. What is the other one? I need the answer from you, my dear. Increase the production, increase the production, increase the pens. Now you have 2 pen, 2 gold coin. What is the price of a pen? Once again, 2 divided by 2 is 1. Therefore, 1 gold coin, 1 pen. Okay. So you have 2 methods. Okay. Now tell me, in a democratic country, you cannot by force remove this excess money supply. You cannot forcibly take this gold coin out. Therefore, you use a method which we called open market operation. It's popularly known as OMO, open market operation. What is open market operation? You have 2 gold coins. What I will do, okay, now price has gone up. You are telling me 2 methods. Very good, I accept. One is increasing the manufacturing. That's right. The other, reduce the money supply. In order to reduce the money supply, with the view to curb inflation, what I do is I increase interest rate. Right. When I increase the interest rate, what happens? Those who have gold coin, the excess one, will find I am giving you 20% return if you hand over your excess gold coin to me and accept my piece of paper known as treasury bill. Now I am giving you a piece of paper. And just for holding this piece of paper, I'll pay you 20%. Now you are very happy. What do? You hand over your excess gold coin, 1 gold coin to me, and accept a piece of paper and keep it in your lockers. So money supply, I have reduced 1 gold coin, and the production is still 1, and I have reduced inflation. That process is known as open market operations. That's what we were discussing. To make PDs, primary dealers, an effective conduit for conducting open market operations. Now I'm doing open market operations. Means what? I'm giving you a piece of paper known as treasury bill, and just for holding this paper, I'll give you 20%. Okay. Now I'm happy with that. What has happened? Money supply I have reduced. The excess money I have mopped out from the system by increasing the interest rate. Somehow, the country has found a mechanism to increase the number of pens. Now the country has 2 pens, but 1 gold coin. Why? The other is in my locker. You have a piece of paper which you can't trade. Country has increased number of pens. Now what is the price of pen? You have 2 pens, 1 gold coin. What is the price of a pen? 2 pens, 1 gold coin. What is the price of a pen? 2 pens, 1 gold coin. Now, what is the price of a pen? Whole money supplies one gold coin. Whole manufacturing supplies two pen. So 1 is equal to 2 now. Now I'm asking price of a pen. What is that? It's not one gold coin. 50, yes, half of the gold coin. Very good. Half of the gold coin. Right. Now what is happening? What do you call it? Price has come down. Any nice term for that, economists? If price is going up, you call it inflation. Now price is coming down. What do you call it? The inflation is going up. Its reverse is deflation. Deflation. Correct. Correct. Right. Many people don't like inflation, especially hyperinflation. When inflation is moving in a very fast track, we don't like it. If so, deflation must be attractive, is it? Now the price of pen has come down. Do you like it? Deflation, is it good? So that's my question now. Is price, so you said don't like it. Very good. Why? Now, if you buy a pen today, that is one gold coin. If you buy this pen after 1 week, it's half gold coin. When will you buy? Price is going to come down. When will you buy? Definitely not today. You will wait for 1 week because the price comes down. At the end of that week, you comes to know the price will further come down. Then you will delay purchasing. The more you delay purchasing, the existing manufacturer will not be able to manufacture the second line. Why? He's not getting cash. As long as he's not getting cash, if you are the employee under him, he is not be able to pay you. Then it is creating another vicious cycle. Therefore, inflation is bad, deflation is bad. On such, what can the government do? In order to absorb your excess money, they increased interest rate. Now, this piece of paper, when I'm going to renew it, they would say, this time we are not giving you 20%, but we will give you 5%. Now, the interest rate has come down. What is happening? I don't want to keep my money in government locker. So I hand over my piece of paper back and take my money again so I can spend. Now, two gold coins and the price is once again 1. So I'm removing deflation. Means what? Open market operation. Government can use a piece of paper known as treasury bill, and by adjusting the interest rate, you can engage in open market activities and look into curbing the inflation or encouraging the manufacturing. Encouraging the manufacturer. Okay. So that is open market operation. How to do that? By issuing treasury bills and adjusting interest rate. Who is involving in taking this piece of paper to the general public? That is primary dealer. Primary dealers should maintain adequate physical infrastructure and skilled manpower for efficient participation in primary issues, trading in the secondary market, and to advise and educate investors. So they must have a know-how. A primary dealer shall have efficient internal control system for fair conduct of business, settlement of trades, and maintenance of accounts. Yes. When you are dealing with money, you have to be very careful. You must have very efficient internal control system. Otherwise, someone, maybe an employee unknown to you, will play fool. So you have to protect yourself. Now, for exam purpose, who is a primary dealer? So your answer is primary dealer is the market maker for government securities. Okay. Now, if it has more marks allocated, then you can write a little bit like this. primary dealer is the market maker for government securities, and they buy government securities directly from the government and with the intention to sell it to others. So so the government will restrict the number of primary dealers and regulate their behavior. Okay. So that's for exam purpose. Right. Another question. When we talked about venture capitalists, we looked at their funding sources. When we talked about specialized leasing companies, we looked at their funding sources. Now, who are or what are the funding sources of primary dealers? Number one, equity capital. The capital invested by the owner. So you call that equity capital. That is the first funding source. Retained earnings. Out of your profit, whatever you have not distributed as dividends will remain in the business, and that will continue accumulating. Therefore, you call it retained earnings. Then, like to any other, you can go for the borrowers, maybe bank, repo. We talked about repo by securitizing a government security. Basically, you can go for the repurchasing agreements. We call it repo agreements. Borrowings in the call money market. For short term, you can go for short term borrowings. These are the funding sources of primary dealers. Now, you have to remember that equity, retained earnings, the rest is borrowings. Call money, repo, bank. Okay. Now, who is the regulator of primary dealers? Who is the regulator of primary dealers? CBSL, correct. CBSL. Just think about perpetual capital, right? Perpetual treasuries. Central bank suspended their license. Okay? So the regulator is central bank. Okay? So the regulator is central bank. Now the regulators role, they appoint the primary dealer. Okay. Now one beauty of regulator is they can issue the license to do the business. Whoever that issues the license to do the business keep authority. What is that? If I can give you the license, I can take the license away from you if you don't follow my rules and regulations, directions. Okay. So CBSL can issue the license, and remember, regulator is like a tiger. Every tiger is having teeth. If you don't have teeth, you are not a tiger. Same way, you are appointing primary dealer, and you can cancel and suspend the primary dealer license. Issuing prudential directions and determinations under the law. Okay. Now we have seen there must be an independent person who can see the entire market. So you call them regulator. The regulator issues directions from time to time, where those who coming under the purview are expected to comply with. If you don't comply, actions can be taken against you. So the regulator appoint the primary dealer, issue directions and determinations, off-site and on-site examination. Means what? The regulator comes to your office on-site. They come to your office on-site and ask you a table and chair and stay maybe a couple of weeks there in your premises and ask certain files and check certain documents. So you call it on-site examination. They come to your place on-site and check. So you call it on-site examination. The regulator can, instead of coming to your premises, ask you to come to there and send you information. So you call it off-site examinations. So for primary dealers, the same on-site and off-site examinations and enforcement of regulatory actions, including the suspension and cancellation of appointment of primary dealers for non-compliance with the law. Remember, in any institute which hand over the license, keep the authority to remove the license. Right? The only instance which I see an exemption is Sri Lankan Constitution after 19th Amendment. Right? So there was a time President is giving the license for Prime Minister, Premiership, but he cannot take it back. Okay? So that's one exemption. In all the other cases, he who gives you the license hold the power to cancel the license. Okay? So the regulator appoint, cancel. Okay? The supervision of primary dealer is carried out to ensure an efficient, sound and safe primary dealer system to promote the stability of the government securities market and to safeguard the interest of investors. Okay. So the primary dealer job is supervised. Why? Because you are playing with others' money and you can make lot of frauds that will make and deter the investor. Therefore, primary dealers are supervised. Okay. The main directions issued to primary dealer. Okay. Now you can be asked, what are the areas that are covered by directions? So the main directions issued to primary dealers cover minimum capital requirement. Being an institute which accept and pay money, you must be able to meet sudden, unexpected payments. Therefore, you must have minimum capital requirement. Capital adequacy, enough capital. Special risk reserve, there can be interest rate serious fluctuations. There must be reserves. Segregationist of securities among custodian holdings. So security market valuation, repo agreements, forward rate agreements, and interest rate swaps, financial statements, dividend declaration, and diversifications. So all these are covered by the directions of the regulator. Whatever you do, you have to comply, follow the rules and regulations set by your regulator. Now we are talking about primary dealer. Our regulator is CBSL, and they govern you by issuing rules and regulations, directions. These directions cover these special areas. Your capital, how much capital, minimum capital requirement, special risk reserves. Okay. The Public Debt Department of CBSL supervise authorized primary dealer through off-site surveillance and on-site examinations. They can come to your premises, or without coming to your premises, they can supervise you. Regularized meetings as well as one-to-one discussions are held with primary dealers to exchange views and to institute remedial measures. Okay, in addition to all of these, CBSL has issued code of conduct for primary dealers to promote best practices in the conduct of trading and compliance. Okay. Right. So primary dealer is a job that accept your money and they will buy government securities, sell it to you. Such primary dealers are closely monitored because if they make frauds, they can make large frauds, big frauds. And the general public may lose faith in investments. Right. Any primary dealer may collapse due to these reasons. Non-compliance with regulations. There are regulations, rules, determinations set to be followed, to be complied. And these rules are set after much deliberation. If you fail to follow them, you're doomed. That's the end of you. Misappropriation of funds. Anywhere, when you have too much money, and if you fail to know where you are spending them, any big business person will fail. Any rich person will fail. The same is for primary dealers. You are dealing with a large number of money. There is a possibility of misappropriation, especially from the top. So I have to prevent that. Fraud and mismanagement. Now, if you ask for exam purpose, what are the causes of collapsing of primary dealers? This is the answer. Non-compliance, misappropriation, fraud and mismanagement. This applies to any business. But there are businesses which you don't have any rules and regulations predetermined by someone else. But for banking and finance industry, it applies. So if you don't comply, you may fail. Misappropriation of funds. You grab and collect others' money by way of deposits and by way of issuing different financial instruments. And if you don't manage it, that's the end. Misappropriation. Fraud and mismanagement. If you allow frauds to take place, that is the end. Primary dealers. The regulatory and supervisory framework for primary dealers in government securities is specified by the regulations issued under the Local Treasury Bills Ordinance and the Registered Stock and Securities Ordinance with effect from 2016. Department of Supervision of NBFI is responsible for supervising primary dealers. Now, who can be primary dealers? There are only two types: licensed commercial banks, dedicated primary dealer companies. Commercial banks can do the business of primary dealership, or there can be specially assigned companies. So you call it dedicated primary dealer companies. Right. Can you tell me some names of primary dealer companies in Sri Lanka? Tell me who can do primary dealing? Yes, you have heard about the bond scam. Then their names came out. Tell me the name. Yeah. Tell me some names of primary dealers. Very good. So one name you can easily remember: perpetual treasuries. Okay. Think about another listed company. We talked about Colombo Stock Exchange, right? There's a listed company who's doing primary deal activity. Okay, right. So that is First Capital. Let's look into this. Licensed commercial banks and dedicated primary dealer companies. You said treasury, perpetual treasuries. Now their license is on hold, but it was a dedicated primary dealer company. Now these are the names: Bank of Ceylon, that's a commercial bank; Capital Alliance; CAL, we call it for easy name tag, CAL, commercial bank; First Capital, that's a listed company; Equity Securities; NetWealth, NSP Fund Management; People's Bank, Sampath Bank, Ceylon; Wealth Trust Securities, Union Bank. So these are primary dealers. What are they doing? They are buying government securities. What do you mean by government securities? If it's short term, what do you mean by short term? Less than 13 months, so we call it less than 1 year. treasury bills. Long term, if the maturity is more than 1 year, it can be treasury bond, rupee loans, Sri Lankan development bonds. Okay, so these are the government securities. Whenever government need money, they can issue these. So you have one less than 1 year, more than 1 year, treasury bills, treasury bonds. In addition to that, more than 1 year category, you have rupee loans and Sri Lankan development bonds. Treasury bills, it's better to know a little bit on that. Now, there was a time if you buy shares, you get a physical thing. We call it share certificate, a piece of paper, and we call them paper money. But today, you don't get anything physical, just virtual. Treasury bills the same. Earlier, you got a piece of paper, now just a number. Right. So physically, you get nothing. It's a short-term investment, and it can be 91, 182, or 364 days government security without any interest, but issued at a discount. Okay. Now we call about treasury bill rate. Unlike FD, when you think about fixed deposits, what happened? The amount that you deposit is printed on the certificate. 5 million. I put 5 million in your bank, and the bank give me a piece of paper where 5 million is printed. Here, I get a piece of paper, but I don't pay the amount on the face value. So I'm buying a discounted one. Say the face value is 5 million, I pay 4.8 million. So I buy this piece of paper worth 5 million at a discount on its redemption. So if I keep it until maturity, then I get the face value. If the security is held till maturity, the profit would be the difference between purchase price and the redemption price. It is issued in Sri Lankan rupees. Right. Now, benefits of treasury bills. Minimum risk since it is issued and guaranteed by government. Okay. So government, whatever they issue, they guarantee. Therefore, the risk is low. High liquidity since it can be traded in the secondary market. Yes. It's highly liquid. You can easily sell it in the secondary market. Joint investments can be made, and no taxation and stamp duty. So these are the benefits of treasury bills. Now we think about treasury bonds. Okay, so our subject today, the main topic is primary dealers. Who is a primary dealer? A market maker for government securities. Who is regulating primary dealers? That is CBSL. What is the role of CBSL? Then you can discuss that. Then what do you buy? You buy government securities. What do you mean by government securities? Short term, long term. What is short term? Treasury bills. What is the maturity date? 1 year. More than 1 year, long term. Okay. Under that, treasury bonds. Here, long term can be 2 to 20 years. Fixed interest government security. This is issued in Sri Lankan rupees. There are two types: conventional bonds, inflation linked. Okay. So you call it coupon. The interest payment is called semi-annual coupon. Right. So you get it 2 times in a year. Benefits of treasury bonds. Minimum risk, the same applies to treasury bills. High liquidity, the same was there for treasury bills. No withholding tax, stamp duty, no tax earlier. Receiving regular semi-annual interest payments. Okay, so you are getting semi-annual interest payments. Rupee loans. Once again, that's another security offered by government of Sri Lanka, a long-term, 2 to 30 years, fixed interest government security. And the semi-annual coupon, basically that's interest. It is issued in Sri Lankan rupees. And the third category under that, development bonds. They are issued in US dollar terms, and the interest is LIBOR plus a fixed margin. Maturity is 2 to 3 years. Then what are the benefits of investing in development bonds? Minimum risk, the same earlier. High liquidity, the same. Returns are being completed tax-free in Sri Lanka, receiving regular semi-annual higher return than a standard deposit. Okay. Now, something we talked earlier. If primary dealers are not managed well, there will be scams, money vanishing into thin air. This is one issue. Perpetual treasury bond scam is another issue. This one, that's a listed company. Okay. Entrust Securities PLC. They faced with a fraud, and the scam was 11 billion. Why it happened? Now you know the reasons. Non-compliance. Okay. We talked that earlier. Non-compliance of the rules and regulations issued by CBSL. Misappropriation of funds, fraud and mismanagement. And the end result was this, a primary dealer collapsing. Okay, right. Wealth and trust securities, good, perpetual, right. Now I'll give you some questions. Let's see whether you can remember what we have been discussing. Who is a primary dealer? Who is a primary dealer? One simple sentence. Who is a primary dealer?
Market maker.
Market maker for government securities. Very good. Who is regulating primary dealers?
CBSL.
Very good. What are the funding sources of primary dealers? What are the funding sources of primary dealers? We just discussed all these.
Equity capital, retained earnings.
Then borrowings, repo from other banks, call money. Okay, call money market. Right, right, good. Thank you. Then we will look into another simple heading, superannuation. Okay. What do you mean by annuities? Annually, you get certain payments. So we'll discuss as the second topic today. Superannuation is an organizational pension program created by a company for the benefit of its employees. Okay, superannuation means a pension program that benefits the employees. It is also referred to as a company pension plan. Funds deposited in superannuation account will grow, typically without any tax implication until retirement or withdrawal. Okay. So these are funds that are keep on growing until you retire. Okay. We talked about Norwegian Petroleum Fund, and I showed that. Okay. Let's see whether we can once again look into that. So you call it Norwegian Petroleum Fund. Norwegian Petroleum Fund. And the first to Google the fund. And I showed you. Yeah, it's active now. You can see the numbers moving. 12 trillion krona. Okay. Now, what is the purpose of this fund? We work to safeguard and build financial wealth for future generations. It's like a retirement fund. Okay. For your future. The picture says it. Means what? A very long-term fund. Okay. Right. So you can go for long-term investments if you can keep aside a certain amount of money each month for the well-being of your employees when they are retiring. We call that superannuation. Okay. Now, tell me, what are the types of superannuation you have? when you retire, okay, who will give you money? In order to get that, very good. ETF is one. Tell me another. ETF, employee trust. Very good. EPF, ETF. Very good. So these are super annuities. That's what we are discussing today. It is also referred to as a company pension plan. Funds deposited in a superannuation account will grow. Okay. Now, why are these funds growing? Remember, our EPF is the biggest fund in South Asia. Okay. They are growing. Why? Okay. They are growing. Why? These funds are growing. Why? Because the number of employees that retire is less. Not everyone is retiring. Everyone is contributing, but very few reach the maturity age and retire. Okay. Now, in your institutions, what is the retirement age? You are working in different companies, banks. Tell me, if you are employed, what is your retirement age? Okay. Okay. So I see a variety: 60, 55, 55, 57, and you have option 55 to 60. Okay. Right. Means what? If you are 20 years old and if you just joined your company, each and every month when you get salary, you find in your pay slip certain amount is deducted by different names, maybe EPF. How long can they deduct money from you? If you are retiring at the age of 60 and if you are 20 years, 40 odd years, they can collect money from you. And if you don't die prematurely, that money will accumulate. Therefore, the money will grow. Right. Remember, compounding interest is the biggest force in the world. Compound interest is the biggest force. Compound interest is the most powerful force. Who said that? Albert Einstein. Okay. The most powerful force in the whole world is compound interest. When you compound, instead of consuming, your fund grows. This is why these superannuities can become massive funds. Okay. Now we are looking at these superannuities. They will grow. Right. Now another example. There was a nice story where a red Indian native sold his own ownership of Manhattan Island of US to a white man, and he sold it at $25. The price of selling this a huge land is $25, and that took place, I think, in 1700, maybe 300 odd years earlier. Mathematically, if this person who got $25, right, means what? There was a person, one individual who had $25. He's a white man. He could offer this $25 to a red Indian and purchase what he owned. So $25 is not a big amount. That is the amount someone had in his pocket. So he could easily give it away and take a huge land called Manhattan Island. Now, if this red Indian deposited this $25 in an American bank at 10% interest rate, okay, and keep on compounding, that value is bigger than US GDP today. No US citizen has more money than the GDP. Means what? $25 those days was the amount somebody could keep is in pocket, something affordable. But today, that amount, if compounded, is not affordable to anyone. That is the power of compounding. The longer the compounding take place, the more beneficial the users get. That's where these pension funds play. Superannuation funds. The investment policy of major superannuation funds continue to focus on earning a long-term positive real rate of return for the members whilst ensuring the safety of investments and maintaining adequate liquidity for refund payments and other expenditure. All of a sudden, an employee may die prematurely, so his funds should be released. And someone may reach the age of maturity, in your case 55, 57, or 60, and the fund has to release money to them. So there must be a certain amount in liquid terms. Right. Now my question is, superannuity funds have to diversify when they invest. Why? So my question is, why do you diversify long-term investments in superannuities? Okay. So if you are a pension fund, you diversify. The best example is here, Norwegian Petroleum Fund. Where do they diversify? They have invested in 9,123 companies in 73 countries. Okay. And they invest in, now this is what has happened. Okay. Throughout the period, you can see how the fund, by compounding means what? You invest money, and out of the return, you reinvest again, and it will multiply in nice amounts. Okay. And you diversify. Why do you diversify? That is my question. Here you can see uh, they invest in they invest in real estates, they invest in shares, they invest in debt instruments. Right? If you take shares alone, they have invested in 73 countries and in 9,000 odd companies. Means what? They are diversifying a lot. So my question is, why do you diversify? Why do you diversify your long-term funds? Tell me your answers. Reduce the risks. Very good. To reduce the risks in investing in one place. Yes, that is one reason. Right. Then liquidity. You have to diversify high risk, low risk. That's what you answered. Correct. There's another area you have to consider: long-term invest and short-term investments. You will invest in treasury bills, which is short-term. Liquidity is very high. Why? Someone may die, someone may retire. So you have to have ready-made cash to pay them. But some others will live for 40 odd years. Then you must have very long-term commitments. Therefore, you diversify. You diversify risk and duration. Short-term, long-term. High risk, low risk. Debt, equity. Okay. Right. The superannuation fund sector consists of EPF, which is the largest systematically important superannuation fund in Sri Lanka. ETF, number one EPF, number two ETF, number three PSFS, Public Service Provident Funds. Number 4, approved private provident funds, APPFS. So you have 4 types of superannuities in Sri Lanka. What are they? EPF, ETF, provident fund, public service provident fund, approved private provident funds. The risk profiles of superannuation funds, particularly of the 2 major funds that EPF and ETF are similar, and their financial positions indicate their risks were managed adequately. The credit risk of this fund is negligible, as over 90% of their investments are held in government securities, which have zero default risk. Very good. Now let's look at Norwegian Petroleum Fund. Okay. Yeah. Now the Norwegian Petroleum Fund, they initially did not invest in shares. Okay. Now Norwegian Petroleum Fund did not initially invest in shares. Why? They only invested in, like our EPF and ETF, only in government securities. Governments in the sense well-managed developed countries like US, UK, France, Japan, Germany. Very few selected countries, debt securities, government securities. That's where they invested. And after some time, when they compared their sovereign wealth fund against other petrol exporting countries' sovereign wealth funds, they found their return is very less. Contrast to that, uh, Qatar, they are performing very well. Why? They are not heavily into government securities. Then only the Norges Bank, the Norwegian Central Bank, decided to diversify into shares plus real estate and keeping a good portion in debt instruments as well, government securities as well. Now, why do you diversify into shares? Because you can get more return than just investing in zero default government securities. Our EPF and ETF, they are very secured. 90% of the investments are in zero default government securities. The funds are exposed to the interest rate risk as a result of high concentration of investment in fixed income securities. But the interest rate risk has been minimized by investing in a variety of securities with different yields and maturities. Yes, that's what I said earlier. Different maturity time buckets. So short term, long term, you have different maturity periods. The fund's vulnerability to liquidity risk is minimum given the steady inflow of funds to member short-term treasury securities. Okay, now we take one by one. EPF. EPF was established under EPF Act number 15 of 1958 to cover any employment, including any employment in the service of a corporation whose capital, okay, so that's the theoretical part. Under the current legislation, any establishment, irrespective of the type or category of employment, becomes legally liable for payment of contribution to EPF on recruitment of even a single employee, but household employees are excluded, right? So if you recruit, if you have a company, if you have only one employee, still you have to pay EPF. The EPF is the largest superannuation fund available for private and semi-government employees. EPF had 2.4 million contributing members in 2016, I'm talking about, representing 20% of the working age population. The total fund balance increased from 1 billion to 1.8 trillion by 2016. The Commission of Labor is in charge of general administration of Act, while financial responsibilities with the Monetary Board. Now you have to remember these parts. Who is in charge of general administration? Commission of Labor. Who is in charge of financial responsibility? Monetary Board of CBSL. The Norwegian Petroleum Fund, similarly, Norges Bank, the Norwegian Central Bank is responsible. Same way, here you have two responsible parties. Commission of Labor, that is for general administration, and for the financial responsibility, you have Monetary Board of Sri Lanka. All employees, either permanent, temporary, apprentices, okay, you can name them by different terms, casual, shift workers, everyone is eligible for EPF. Under EPF, as mentioned above, employer and employee are required to make monthly contribution. Okay. Can someone tell me what is the contribution by employee and what is the contribution by employer to EPF? You know these things when you take your salary.
ETF 3%.
Once again, yeah, 8% and 12%, altogether 20%. Right. So that is the contribution. Both parties have to contribute, employer and the employee. Earnings for the period include salaries, wages, cost living. Okay. Out of all, you have to pay EPF. Employees. Employers are prohibited from compensating themselves for this contribution through reduced wages. In the event this happens, the commissioner can order the employer to pay the presumed difference in contribution. Now, some poor employees, they say, please don't deduct EPF from us. They don't see long term. Therefore, it's a punishable offense if you don't deduct EPF. Some employers show a small amount as the salary and deduct a small percentage. And they have some other allowances and some other names. And the employee and the employer are both happy in the short term. But in the long term, the employee will not be happy and may go to courts against the employer. Then both will become unhappy. Okay. Remember, when you retire, automatically, without much effort from your end, there is a fund for you to look after yourself. So you have to contribute to that, and your employer has to contribute to that. Employers are also not allowed to deduct the contribution among the employees' earnings. Okay. The EPF mainly provide income security after retirement to contributing members. Members can withdraw their EPF account fund balance after reaching the age of 50 for females and 55 for males. Now there were discussions to increase it up to 60. The government may prefer. Why? Because you can use that money for more long-term projects. But the employees may like to get best of both worlds. What is that? The employees prefer to work to the maximum possible number of years. Okay. Now, if I ask you, how long do you want to work before retiring? Suppose there is no age limit. Tell me honest answers. When are you going to retire from your employment if there is no age limit? If there is no retirement age, 60, 50, others? Okay. Okay. Good. Right. The government, from time to time, there are efforts to keep you until 60. So until 60, government want to employ you. Maybe they can keep and invest this fund for more better usage. But I've seen many unions were against that. They want the best of both worlds. What is the best of both worlds? Okay, I want to keep my job until I reach 60, like you. But if I prefer I must be able to withdraw my money at 50, EPF at 50. Okay, and some even before that, maybe at the age of 40, you want to withdraw what is already saved for you. Right? Right. Now the theoretical side, you can take your money back if you are a female at the age of 50 and if you are a male at the age of 55. The refunded amount consists of all accumulated contributions and accumulated interest. Members can also withdraw their account balance before reaching the specified age if they leave workforce due to permanent disability, migration, joint pensionable employment, or upon marriage for female employees. Members can nominate beneficiaries to be eligible to receive funds if the member dies before reaching the prescribed age. Yeah. However, EPF falls short of providing private sector employees income security in their old age. This is because, number one, EPF provides a lump sum payment instead of a periodic income. That's another nice problem among Sri Lankans. Thanks to free education, okay, what is the reason for age difference? It's like this. Now, not only age, even marriage. Let's say there are a lot of girls that happen most of the countries. There are a lot of girls who come from villages to work in factories until they get married. That happen in Thailand, Malaysia, or Sri Lanka. When they want to get married, they want their EPF back, their superannuity back. So that is given. That is not given for the males. Right? The other, for males, most of the time, males are breadwinners in Sri Lanka. Therefore, they want to work until 55 or 60, where females prefer, like at the marriage by these girls coming from villages, especially in factories, you find that. Okay, the females prefer to retire early and take the EPF and hand over that money to their children. So based on that, there is a age difference for male and female, and the marriage, that is another condition. Okay, now what I was emphasizing is one drawback of EPF is said to be providing you a lump sum, right? It's like you have been working with us forever for 40 years and now we are retiring. Here your lump sum, take it and look it after. But in Sri Lanka, we don't like to take the responsibility of our own lives, unfortunately. Okay? Thanks to free education, you get a very expensive course free of charge at universities. After completing, after graduation, now what do you want? A job by the government. Okay? And when you retire, you don't want the lump sum. What do you want? You want continuous monthly salary like thing. In short, we are afraid to manage ourselves. Okay? We are afraid to find a job ourselves. Government must find it. Okay, now I'm working. I can't look after my investments. So let the government look after my investments. So comes EPF. When I'm retiring, the government is giving me a lump sum. Hey, look here. Hereafter, you manage this lump sum. There's a good amount, 6 million. But I would prefer no. At the moment, I am earning 100,000 when I'm retiring. And until I die, can the government give me at least 90,000 per month until I die? Means what? Instead of taking the responsibility of this lump sum. Many prefer even that is managed by the government. Okay, so that's there. The EPF provides a lump sum payment instead of a periodic income. Okay, why can't you give me a periodic income? There is an inadequate replacement in income. Okay, this is why some people don't like to retire. Since the EPF refund is a lump sum payment at the retirement, it is sole responsibility of the retired person to effectively manage that money to provide their own income security for life. And people don't like that. They don't like to undertake responsibilities. Okay. In Sri Lanka, we have trained the mindset in such a manner somebody must look after me. Okay, there must be free education, free health service, everything free, and they must look after me from everything, and I don't do anything. I just work, and my fund is managed by government. When I retire, they have to still continue paying me some money, and that must be adequate. When they hand over me lump sum, I don't like, because I can't manage that. Okay. So these are some thinking pattern issues. Hello. Okay. Since the EPF refund is a lump sum payment, so people don't like to take that. Purchasing an annuity is not a realistic option for most members since the annuity market in Sri Lanka is limited. Even if the individual was able to invest their EPF funds as annuity, it would be inadequate income for most. Right. Now, in Sri Lanka, you don't have much options. The only thing government is looking after you. Now comes EPF. EPF Act of 1958. Now that is the legal side. Employer can contribute towards the APPF instead of EPF. In 1996, the legislation was introduced preventing the establishment of new approved provident payment funds, although the existing approved private provident funds were allowed to continue. There were 177 approved private provident funds in 2006. Right. And now approved provident funds are slowly going down. Now you know the percentages, 8%, 12%. Now I'm putting that in summarized. Fund is managed by monetary board but administered by Commission of Labor. ETF, now you know the contribution. On salary by employers and all managed by ETF fund. Now I asked you the question, why do funds diversify? To maintain liquidity, so short term, long term, reduce the investment concentration risk. If I invest only in one area, if that area fails, that is called concentration risk. Therefore, to mitigate the risk, I'm diversifying. Enhance the rate of return. That's what I said. Norwegian Petroleum Fund earlier invested only in government securities and the rate of return was very low. Therefore, they diversified. Now they can improve their rate of return. What is concentration risk? If I keep depending on single party, then if that party moves out, that is the concentration risk. The risk arises from observation that more concentrated portfolios are less diversified, and therefore the return on underlying assets are more correlated. Okay. Right. Now, how many of you have planned your retirement? Yeah, so you have EPF and you may have ETF, right? In addition to that, do you think you can manage your own pension fund? And are you working towards it? Okay, I'm not trying to sell any product. We don't have any such product. But in insurance companies, they have pension funds. Okay, they have nice investment funds. Okay, right. I'll just read out. Yeah. I'll read out one nice statement from a book that I read these days, The Science of Money. Right? Somewhere it says, the writer says, let's assume there are 100 people who start to work today. One will be rich, four will be well off, 15 will be financially independent when they retire. Means what? If 100 employees start to work today, when they retire, one will be rich out of 100, four will be well off, four will be really okay, 15 will be financially independent. Means what? 20% of the employees, when they reach the retirement age, will have sufficient money to look after them. What about the rest 80%? They still want to work when they reach retirement. Okay, so that's something you have to think well ahead of retiring. Okay, now many people prefer government jobs. Why? Because they believe the government will continuously look after you even after your retirement. Therefore, in Sri Lanka, very few graduates prefer to look into private sector. That's something very bad. Our thinking patterns are not created in such a manner to look after ourselves. Therefore, we prefer someone is looking after ourselves. Amidst that, the insurance companies are trying to sell investment packages, and they find it's very difficult. So, if you ask from insurance brokers, they would say it's difficult to sell these products to Sri Lankans, right? And very few people buy. Like this book talks about the Americans, okay? And it's the same in America. Only 20% of the people who start to work today will retire with financial independence. Other are still dependent. They want to work somewhere, short-term jobs, casual jobs. They can't look after themselves even after retirement. When should you think about that? Not when you are 50. Suppose your retirement age is 55. You have to think when you are 20s. When I'm going to retire. When I retire, who will look after me? Okay. So in Sri Lanka, there is another nice answer for that. My children will look after me. Okay. Still, that says I can't look after myself. Okay. So when you are young, think on these issues very seriously. Now, during this COVID, I still feel and see many people comment, why can't government impose curfew? Okay. Then some argue, so you restrict movements yourself. Why do you want government to do that? Yeah, that's a good one. Yeah. Right. Now, today we first talked about primary dealers, then went to another small heading. There was only one question so far under this heading, retirement or the superannuities. Remember, when I started to teach, I first took insurance. In most of the papers, there are questions on insurance. Unit trusts, there were a lot of questions on unit trusts. Then we talked about pawning, there were questions, venture capital, there were questions, right? Now I am taking another main heading that is often repeated. These two, primary delay is another often repeated question, but superannuities only once asked, but it's better to prepare. Okay. Now I'm taking you to another main heading that is often questioned one. But yeah, payment systems. That's a question so far continuously repeated in past papers. So I'll take a little bit of time and describe it slowly, unlike superannuities, which I completed very fast. Right. Why do you want money? Why do you want money? Okay. To buy needs. Good. That's one thing. Yeah, to meet your expenses. What else? Is that all what money can do? To fulfill your basic needs. Yes. Is that all what money can do? To save for future needs. Very good. Now, I have seen so many people got affected due to COVID, almost 2 years. Right. Tell me some jobs or categories of services that got seriously affected by COVID 19. Tell me some areas. Yeah, you have, yeah, hotel that's affected. What else? Tell me quickly some areas. Tourism, all tourism related. What else? Hospitals were not affected. Apparel, not much. Okay. Okay. Think about your village, your town. How many saloons got affected? Whenever you impose curfew, saloons got affected. Then tuition classes, school vans, right? Then those who are running canteens, cafeterias at schools, right? Those who are coaching sports, swimming coaches, badminton coaches, think about all the coaches. Think about the places. Think about a swimming pool, pool attendant, then number of employees working there. Think about a badminton court, number of jobs. Think about tourism related, right? At the same time, I'll show you, I'll show you some of the companies that have been doing perfectly well. Okay, so this is Columbus Stock Exchange, and I'm taking you to a company, Haley's, right? And now you know how to look into financials. Okay, I'll go for quarter reports. Now this is Haley's company, quarter report on June, right? So these reports normally compare quarter to quarter. Last year, in this quarter, what was our performance? And this year, in the same quarter, okay, so they have come up with a nice term, exceptional. So it seems their performance is exceptional. Revenue has gone up by 46% compared to last year. Profit has gone up by 539% per quarter. Okay, right. That's what I'm saying. Even though many areas got affected, but still there are companies that performed very well amidst of this tourism. Okay, right. Now, there may be reasons when others find it very difficult to live, some others thrive. That's why you diversify. So if you have invested in hotels and only in hotels, you will find extremely difficult to survive. Okay? But if you have invested in a hotel, Asian Hotel Properties, and Haley's. One has failed, the other has thrived exceptionally better. Means what? Now you are averaging your investment. Okay. Now my question is, the Norwegian Petroleum Fund, they were not having petrol earlier. Norway was heavily depending on selling fish and some other raw materials. The moment they found oil, they thought this is excess money. And they knew what happened to Dutch. They found oil, and after a few years, oil disappeared. Today in Dubai, you don't find a single drop of oil. Oil is not a resource forever. When it's gone, your income is gone. Right. Now my question is, when you have excess money, what is the best thing to do? Norway is doing that perfectly well. Now Haley's, they get excess money now, right? Amidst of all this crisis. When you get excess money, what is the best thing to do? When you have excess money, invest. Invest. Means what? Money is not only for meeting your day-to-day consumption, but also for long-term investments. Right. So there are motives of money. Why do people need money? There are different reasons. What are they? Transaction motive. This is what you said. I want to do day-to-day transactions. For that, I need money. Precautionary. I'm running a hotel, and due to COVID-19, the hotel is closed for almost 2 years. Prior to that, thanks to Saharan, I had no income for another year. Right. For 3 odd good years, I'm facing problems, but still I'm surviving. Why? Because when I had good money, excess money, I invested. So I keep a little bit of money for rainy days. We call that precautionary motive. Now investing, speculative, not saving, speculative. I make money to make money, and you call it speculative. Okay? Now these days I see lot of speculations taking place. One is in US dollars, heavy speculation. The other in vehicle market, nice speculation. Then in Colombo Stock Exchange, right? Amidst of all, each and every day, what do we come to know? Market is, sorry, what do we come to know each and every day? The highest number of deaths due to COVID-19. But what is happening in the market? 197 units going up, and the turnover is 2.9 billion. Continuously, the market is moving with heavy loads, billion, 2 billion plus. Okay. So people are speculating. Right. So you have three reasons to hold money. Bartering or exchanging is one. The other is speculation, and the other is precautionary. I buy things out of money. I keep a little bit. If my current income fails, I have to live for at least 1 or 2 months. For rainy days, I keep money. Then I keep another set of money for what? Speculation. Right. So these are the reasons for holding money. We are talking about payment systems. Initially, at the very beginning, it is said people were not having a medium of exchange. Instead, they started bartering. I sell my excess to you. I'm exchanging, not selling. I'm giving my excess to you, and your excess is accepted by me. Okay. So that is bartering system. But I have heard and I have read in certain documents, they wonder when this system was in practice. There are arguments, okay. Is this real? Were we really bartering? Or from the non history, were we using a medium of exchange? Right, even in Sri Lanka, from the very old non history, except the prehistoric man, we have been using some kind of medium of exchange and mostly a formal one, run carbon, run muscle, something. If you go to many museums in Sri Lanka, you will find a payment mechanism, currency in place. Okay. Now, just out of curiosity, how many of you have gone to Dutch museum in Colombo Fort? Say yes or no. Dutch museum in Colombo Fort. Have you ever visited? Now, if you go to this Dutch museum, you will see different type of coins used by Sri Lankans. Mm, and if you go to the main museum, the Colombo Museum, you will find even Chinese coins found in Sri Lanka. Means what we have been doing even foreign exchange using currencies, even in those good old days. Commodity money. Now I'm talking about payment system and I'm slowly looking into that. Commodity money means I'm using something for a purpose. While using for that purpose, I'm using it as a medium of exchange. So that has been there for the longer period, right? So I'm looking into gold. I can use it as a jewelry. When I need money, I can exchange that. Lot of other things like seashells, feathers, then your tools, maybe swords, your axe. So all this became commodity money. So it has two values. One is exchange value, the other intrinsic value. Gold is like that. Okay? So gold, silver became commodity money for many generations. Yeah. Now, in good old days, when you have this kind of round shaped gold accepted as money, when this gold is being circled many times, when it exchanged many times, the goldsmiths, whenever they come across a coin, they used to peel off the edges. And after maybe 100, 200 dusting of these edges, they can make a coin out of themselves. So the government, those days the kings, they preferred to not to allow that. So they made ridges at the edge of coins. So if someone peel the edge, you can immediately, by running your fingernail, you can trace that. Right? So from the non old days, man was trying to make certain frauds in the payment mechanism, like this one. And throughout this history, the authorities were trying their best to prevent frauds taking place in payment mechanisms. Okay, right. Now, before moving ahead, I would say we'll have next class in Saturday, and I arranged this additional class because I missed one class in the previous Saturday. So if not, I miss any class, we will have the classes in the usual time on Saturdays. Okay, and we have few more main topics. After this one, we may talk about leasing and cooperative societies. After that, we will look into some directions by central bank, capital adequacy and Basel, then directions on corporate governance. After that, we will look into questions and answers. Okay, so I'm requesting you to start seriously studying the notes which I have given you. Then use your internet wisely. You can move around. Let's say this site, Colombo Stock Exchange. When you surf and find different companies, look at what is happening in Sri Lanka. Okay. So when you talk to politics and when you listen to the news of Sri Lanka, you will always see negative things. But there are many positive things as well. Okay. Now think about another company, right? So I'm showing you the performance of them. The quarter of June. Okay, so this is a plantation company. Okay. Revenue has gone up by 35% and profit has gone up by 78%. Right? But in the political forums, we all see so many negatives. Yeah, I will definitely look into past papers and we'll discuss questions, past paper questions. I'll give you the question, give you some time, then I'll discuss and show you the answers. I'll guide you the answers. For that, I want you to go through these notes. Say insurance, right? What are the two types of insurance? Then the concepts of principles of insurance, then reinsurance, bank assurance law. Likewise, all what I have done, you have to be 100% okay. Now it's time to look into these past papers as well. So be prepared. Very soon, I will take some time, say about 1.5 hours for the topic, then 30 minutes on question and answer session. Most probably by next week, I'll start that. Okay. So be prepared with what we have done so far. Okay. Right. Now back to our session. We said payment mechanism was protected by regulators. Now comes a nice situation. If you think about American dollar, okay, right. Until Second World War, America was a self-isolated country. They were not interested in involving in someone else's territories activities. Okay. England and France, Spain, Portugal, they were the countries that were trying to become the regulators of the world. But USA, they preferred as isolated. They never want to intervene into others' matters until their own Pearl Harbor was attacked by Japanese. Then they joined and became a strong force. After Second World War, there was an agreement, Bretton Woods Agreement, and US dollar became the base currency of the world. There was this agreement. What is that? A dollar, $1 is backed by a commodity. If you have $1, you can go to the treasurer and ask a commodity on for you. Okay? But in 1968, America was involving in, say in 1970s, America was involving in a war, Vietnam War. And they found their currency standard is not supportive. In order to win the war, you have to spend millions, billions. And what you can do is you can print money and hand over them for soldiers and weapons and all these things. But unfortunately, you don't have that much of metal in your treasury. You don't have silver or gold in your treasury to the amount of money you needed to end the war. So US came out of Bretton Woods Agreement and US currency became a fiat currency. What is fiat currency? Until then, it was commodity backed. Means what? If you hold gold, if you hold American dollar, you can go to the Treasury of America and ask a commodity, a silver, payable to the bearer on demand. On US dollar note, that sentence was there. Okay, shall we see it somewhere else? Yeah. Today you have fiat money. Fiat money means there is no physical commodity backed. Okay. Now before that, there were commodity backed. Something like this. Okay. So there will be a sentence at the end saying, to the bearer, you can claim this much. Yeah, $1 silver payable to the bearer. So that sentence is here, right? So in 1968, if you take American dollar note, here, just after the image of this person, 1 silver ounce payable to the bearer. That kind of sentence is there. Means what? It's a commodity backed money. Okay, I'm talking about payment system, and we looked into money as a medium of exchange. Initially, that was commodity money. Means what? It can be something used for some other purpose and also used as currency. Gold is one ideal. Later on, what happened? We went out of commodity backed and it became fiat money. Means what? You don't have anything under $1. Here, under $1, you have another nice statement. To the bearer, you can claim this much. That is removed. Because of Vietnam War, you had to spend more money, and now you can print money and give away without backed by any commodity, neither gold nor silver. So $1 means $1. It's just a piece of paper. So our faith based, it's no more based on a commodity, right? So you call it fiat money, a money that government guarantee as legal tender. Okay? Now, in your free time, take any currency note in Sri Lanka, maybe 20 note bill. Okay? ශ්‍රී ලංකාව තුළ ඕනෑම මුදලක් ගනුදෙනු කිරීම සඳහා නීතියෙන් වළංගුය. නීතියෙන් වළංගුය. Okay? ඕනෑම මුදලක් ගනුදෙනු කිරීම සඳහා නීතියෙන් වළංගුය. So what does it mean? That is the fiat notice. Okay? So the fiat notice says it is legally valid to do any kind of, any amount of transaction with this money. It has no intrinsic value. Commodity money, it has a commodity value. Okay? And the government guarantees there. US dollar is no more a commodity backed one, but a fiat money. Now we started to believe in a piece of paper that became our payment mode. So it maybe after 1970s, until 1970, the base currency was backed by commodity. But now it is purely a fiat or the legal tender. Right. A payment system. Now we are looking into our main subject. A payment system is any system used to settle financial transactions through the transfer of monetary value. This includes the institutions, instruments, people, rules, procedures, standards, and technologies that make its exchange possible. Okay. Now, when I was reading about Walter Disney's autobiography, he says when he started uh, Disneyland, each and every item has a value, a coin value, right? So if you want to use the seesaw, let's assume, you have to pay a coin. And now you go for the roller coaster, you have to pay a coin, right? And there were cashiers who were collecting these buckets and weighing them. Okay, instead of wasting time on counting, you weigh them and go to the bank and hand over, right? So that's extremely difficult. Today, we often use some other mechanism for payment, say credit cards. Okay, physically we use nothing. Then online payments, then m-commerce, mobile, using mobiles. And today we we don't use much checks, right? We have many other payment mechanisms. And there was a time when you want to go to foreign country, you look into travelers checks. Now no more required. Okay, so things are changing. So that's what we talk under payment systems. Okay, still there are people who ask physical cash, right? And one common thing is most of them are small companies. So if they want to go beyond your limits, then you have to look at the payment mechanisms. Okay, now tell me, what are the advantages of having a credit card? Yeah, what are the advantages of having a credit card?
And we use as a deferred payment method.
Yeah, you can use it for deferred payments. There was a nice statement by Warren Buffett. Let's see whether we can find that statement. Okay, so his statement is, if you want to become a rich and if you have a credit card, take a pair of scissors, cut the credit card into two and put it into dustbin. That is the very beginning of becoming rich. Let's see whether we can find this statement, Warren Buffett on credit cards. Okay, let's see whether in images or somewhere that statement. Okay, I found this one. Anyway, that was a popular statement by him, right? If you have a credit card and if you want to be rich, take a pair of scissors and cut it into two. Later on, uh, Robert Kiyosaki got a nice statement, how to become rich while having a credit card. Okay, but let's see another statement by him on credit cards. Credit card advice by Warren Buffett. I've seen more people fail because of liquor and leverage. Leverage being borrowed money. You really don't need leverage in this world much. If you are smart, you are going to make a lot of money without borrowing. Okay, so that's his way of thinking. I'm not going to say that is the only way of thinking, but I'm checking this statement. That was a very popular statement those days. Okay, right, fine. Right, okay, fine. So credit card has become a very popular way of payment mechanism, and there are many advantages out of it. So when you look into payment mechanisms, you can first pay by cash. So these are the accepted modes of payment in Sri Lanka. Non-cash. When it's non-cash, it can be document-based, checks, money orders, bills of exchange, promissory notes. Now, this document-based payment system is slowly moving out of fashion. Slowly, people are no more in demand of this document base. Now everyone is moving into electronic payment mechanisms. So credit cards is one such popular method. Okay. Yeah. Now, how many of you have credit cards? Okay. So I'm not against credit cards, right? I I use and I have credit cards. How many of you have credit cards? Just say yes in your if you have a card. Okay. Right.
Yes.
Okay. Right. Right. When I joined as a management trainee, my first entrance to finance was right. My first activity was taking a credit card. I'll tell you why it is important as a payment method. One supplier of us, he's doing a very small business, but yes, he's rich from his context, from the way he's living. Anyway, one day his little boy fell from a top and he immediately rushed with this injured child to the hospital, to a private hospital. The private hospital, before admitting him, put into him some conditions. Number one, do you have an insurance, health insurance? He said no. Number two, do you have a credit card? He said no. Then number three, you have to make this much of deposit. That's where credit card matters. You can, as you perfectly said, correctly said, you can defer your payments. Right? Sometimes in a rush, you can even ask to increase your credit limit, and it will discipline you to enter into the financial world. If you have a good use of credit card, somewhere I saw that answer as well, you will get short-term credit loans, personal loans at a very low interest rate. I'll tell you one nice example. One of our very good employee, his designation is driver, right? And most of the credit card service providers, say banks, they avoid this category to give credit card. Somehow this driver took a credit card. He's a very careful use of it. And after a few years, the bank offered him personal loan. And the loan was very low. What he did, he took this loan and put a fixed deposit with us. That alone gave him a good margin. Means what? If you are a credit card user and show your if you build your payback history well, the bank will give you more and more opportunities. Okay? And later on, normally many credit card sellers to our premises those days when COVID was not there, and he got application from another bank. And in this application, you have to fill, write your name, and there's your designation. He has thought, okay, if I put my designation as driver, I will not get a credit card. And he has put his designation all rounder, right? And the non-related somewhere referee, my name was put. Then the bank called me and asked whether there is a person who is employed as an all-rounder. I said, no, there is no such designation. But if you are referring to a credit card, I would say he's a good credit card user. Anyway, that particular bank also gave me a good credit card, a good amount. So unlike those days, like what Warren Buffett says, today I find a lot of well-mannered credit card users. And we are moving out from cash to document-based to electronics. Okay. So in Sri Lanka, for example, let's remember, these are the payment modes: cash, non-cash. Under non-cash, we have two types: document-based, electronic. I see the trend, electronics are becoming popular. Okay, so with that, I'll end today's session. Okay, so next Saturday, we'll meet and continue the rest on the payment mechanism. And say for 30 minutes, I would take past. I will give you a question from past paper and we'll discuss. Okay, so with that, I'll end today's session. Thank you. Good night.